Alright, sorry, I'm not supposed to do that. Okay, good evening everyone. Basically, this video is to explain how to manage your risk because I keep getting DMs concerning how do I manage my risks, how do I control risks, you understand? So, the one thing you should understand about risk management is that you need to understand what you are willing to lose per trade. That's the most important thing. What you are willing to lose per trade, not in general. Mm, You can decide to lose 0.5% now and decide to risk 1% on the next trade. But the most important is the particular trade you're taking on at that particular point in time. So it's important for you to understand your risk per trade. So your risk per trade will determine what you will be doing and how you'll be taking losses or whatever. You understand? Because losses is part of trading. In as much as profit is part of trading, you need to know how to take losses the right way, not the wrong way. So when I drop a trade, I always say manage your risk. Sorry about that. I always say manage your risk for a reason. Now my stop loss is always 20 pips from entry point. 20 pips from entry point. That is always my stop loss. I always keep my stop loss at 20 pips from entry point. I don't like adjust, or it's always 20 or below. It can be 19, it can be 17. You understand? But it's within 15 to 20. That is my stop loss. So before I take on the trade, I always define my risks for that trade. You understand? I always define my risk because that's what gives me confidence. You understand? So okay, I say I'm willing to risk this. So by defining what I'm willing to risk, we just have to go about determining the lot size for that risk. Let's say I want to risk. Let's say I have $200, and I want to risk 2% of $200. You understand? To risk 2% of $200, we just have to do 200 times, if I'm not mistaken, 200 times 2 divided by 100 will give you the risk. Let me do that maths. Just give me a minute. Let me do that maths very quick. Let me do the maths very quick. Say 200 times 2 divided by 100. That is $4. My risk is equals to $4. You understand? $4 is my risk. Now, if $4 is my risk, what will be my lot size? Because most people don't know that. Your lot size will be your risk, which is $4 divide by 20 pips divide by 10. Sorry, space. This is divide by 10. That will give you equals to just it's simple mathematics. You say your risk is $4 divided by 20 divided by 10. So I'll be risking for $4. I'll be risking my lot will be 0.02. Now when it has given you the lot size to use, you have to check if that broker. Another thing, you have to check if that broker can allow you use that lot size, because most broker won't allow you to use that lot size, but SNS can maybe allow you, but most of them will not allow you to. This is mini lot. You should know that this is mini lot. 0.02 is mini lot. So this is mini lot. So if price should go down to 20 pips, you will lose $4. So from your entry point, you draw down to where your stop loss will be, which is 20 pips. You have determined the risk for this trade. You understand? This is for gold. Every other pair have the way they do their own. Oil is the same process too. But synthetic is different. The way you calculate risk in forex pair is different from synthetic pair. I will do that, maybe do a video of that later. But I just want to give you an overall view of how you calculate risk. Now, 20 pips. You shouldn't risk more than 20 pips. That is my rule. In every trade I take, I don't risk more than 20 pips. And my target is always 100 or 100 to 600, 60 pips, 90 pips, depending on what the structure is giving me. That's what I'll be risking. You understand? So that's how I calculate my risk. That's how I manage my risk. Now, once you're on it, once I maybe drop is set up, and I'm saying, let's say from the entry point, I'm expecting a buy. You understand? I'm expecting a buy. You have to know when to place break even. Another thing is break even. Break even is like it's like a shield. You understand? A shield when you're on the war front. Let me use it that way. A shield when you're on the war front. Let's say we have a trade. Like this trade is buying at 50 pips. You understand? This trade is buying at 50 pips, and we're risking 20 pips. This is our risk. And we see that price is already moving and it has tapped us in. You understand? Now, how do I manage my risk? I manage my risk like this. Once price has moved 50% of that 50 pips, I set break even at entry point. Once price has moved 50%, let's say from year to year is 10, from year 20, year 30, year 40, and 50 is the main TP. You understand? Now 30% is like I say, let's say 20 pips. So once price has moved from here to this particular 20 pips, I will set my break even at entry. Now the only bad side about break even is that price can come and retest that level and still go in your direction. That's the only bad side about it. But it helps to protect your capital or protect you from taking random losses. You understand? My strategy, our approach with SNR is that when price comes to our entry, it taps and move. That is how our strategy. That is based on backtesting data. That's what we expect price to do. But if price doesn't do that, we just have to be, be careful. I don't have this video supposed to be long like this. You just have to be careful. You understand? So being careful is putting your shield, which is your break even. So if price should go 30% up of your entry point, you should set break even at entry. Most of the times I won't set it above, I will set it close, very close to the stop, below it, but very close. You understand? So this is how you manage your risk. You understand? If you have any more further information, just ask me. I'll be obliged to enlighten you better. That's it. Thank you.